It's a great time for us to reinforce what we have been teaching about
Yeah.
on this show, especially over the last 2 years, about how our 30-year mortgage rates come to be and may be somewhat affected by the Fed cutting the Fed funds rate. But there's a whole lot more to it than that. And over the course of the last couple of years, we've talked about how rates have gone up, even though the
Mhm.
Fed hasn't raised the Fed funds rate. And now we have an example where the interest rates for all of our mortgages has gone down substantially, about a half point,
Mhm.
even though the Fed held the Fed funds rate steady. And the reason is because the most correlated to our 30-year average interest rates is actually the yield on the 10-year treasury. Because at the end of the day, what drives our mortgage rates are just investors on the other side of the table. And there's an investor on the other side of the table, and he or she is saying, you know what? I could put my investment in mortgage backed securities, or I could put it into 10-year treasury. And over time, there typically is a certain spread between those. And they basically say, well, the risk is commensurate with that spread. And so, if we want to know what's going to happen with our interest rates, we need to look at what's happening with the 10-year treasury yield,
Got it.
not so much what the Fed funds rate does.
Yeah.
So when the 10-year treasury yield
Mhm.
goes up, our interest rates on our 30-year mortgages go up. When the yield on the 10-year treasury goes down, our mortgage rates go down. And the yield is inversely related to the price.
Okay.
So when the yield on the 10-year treasury goes up, that means that less people are buying. So there's less demand for it. So
Yep.
what's happening right now is the opposite, right? The
Demand is
yield
rising
on the
for it.
10-year treasury is down.
Okay.
Demand for the 10-year treasury is up, and that's why our mortgage rates are down.
Got it.
Does that make sense? There's
Got
a lot of up, down there.
uh,
But long story short, 10-year treasury down is a good thing for lower interest rates.